The life insurance sector has been an important part of market chatter amongst various analysts and investors. Plus, in the last 6 months, we've seen multiple regulatory changes come by. Also, the budget which went by had fair bit to talk about the life insurance sector. Now, the insurance companies, particularly life insurance companies, so far have been resilient and shown strong growth despite all these disruptions. But are we bracing for a low growth environment? To speak about that and many more things, we're joined by Vibha Padalkar, the Managing Director and CEO at HDFC Life Insurance. Thank you so much, ma'am, for speaking to CNBC TV18 at such an important point for the sector. What I want to ask you first is that we've seen 2 months of FY24. Your premium growth has been a decent 14% growth. APE, the total APE is 31%. What I want to understand from you, in the first 2 months, what has been the sort of VNB growth that you've derived on a year-on-year basis?
So like you said, Yash, and thanks for inviting me over here. We've tracked reasonably well, given that there were tax changes that happened on 1st of February, effective 1st of April. Given the avalanche of business as a sector that we did in the month of March. So to some extent, perhaps there was advancing of people buying their life insurance policies, which is always a good thing. Against that backdrop, like you've said, HDFC Life has fared reasonably satisfactorily. So we have typically grown between 1.8x to 2x of the private sector and slightly higher as a multiple of the overall industry. May was better than April, and hopefully June will be better than May. And that's how the turnaround from being a higher average ticket size focused sector, we are moving into deeper penetration, and that's again the right way to go. I'll give you a few numbers. On an APE, what you mentioned was overall business. On the retail APE business, we grew 9%. Again, that was 1.8x the sector. Our market share expanded by, from about 16.5% to 16.7%. Similarly, on group business also, we retained our number one position in the private sector, and our market share grew over there as well, and we clocked 25+% growth. Again, it was over 2x the private sector. What was interesting is the number of policies growing as well. So there also we grew 2x the sector. But what's interesting is that the month of May showed double-digit growth in the number of policies, which again shows moving inward, and trying to cover more and more lives. And the bugbear in the last recent quarters for the sector that has been on protection. So retail sum assured and hence retail protection also has grown upwards of 50%. So that also has seen a turnaround. Last year also we grew sequentially, but this year YOY growth that we are beginning to see in retail protection as well as other end of the spectrum in terms of annuities and retirement. So it has been a holistic picture, and so the building blocks for this year are reasonably sound.
Of course, the numbers so far has been improving on a month-on-month basis also. The analyst community particularly are interested as far as the VNB growth is concerned. In the first 2 months, with the kind of APE growth that you had, with the kind of premium growth that you've had, what is the kind of VNB growth that you sort of derived out of these numbers?
On a full year basis, our VNB growth should again be in the mid-teens, which will be very much in line with our top line growth. And we're saying that on the visibility that we have today, and we will again take stock halfway through the year, we should grow by mid-teens. And thereby it would imply that we would hold on to, or thereabouts, hold on to our new business margins.
Okay. In the earnings call that you had mentioned that you expect to continue VNB expansion with faster APE growth in FY24 as compared to FY23. You sort of spoke about VNB growth will be somewhere in mid-teens. There was a very interesting note which came out recently which spoke about that the stock price would not get the kind of multiples from investors, would not be able to sustain those multiples if 20% plus VNB growth is not achieved. What I want to understand from you is two things. On the APE side, where do you see FY24? And on the VNB side, you said mid-teens. What will be the strategy to sort of take it from mid-teens to 20% plus?
So on the APE growth, this is without removing the above 5 lakh policy, that level, just adjusting for the normalization in March, what we have said is we are gunning for mid-teens, and hence VNB will be mid-teens. Now, if I were to compare growth like for like, which means that I exclude above 5 lakh ticket size policies in my base, then it will be about 25% growth, between 20 to 25% growth, right? So that is how it needs to be seen in that context, and so that number is not fully understood or appreciated, given that I'm not withdrawing the base effect as a result of the tax change. And having said that, if you were to cut H1 versus H2, I'm reasonably sure that H2 will show much higher levels of growth, closer to the trend of 17-18% that we have been consistently delivering. That we should see that in H2. H1 so far YTD May has been say 9-10%, and I said June should be better than May, and then quarter 2 should be better than quarter 1, and that's why H2 should be noticeably better than H1.
Okay, that's a good fact that you put out. On the margin front, I want to understand a derivation of the VNB and the APE growth that you see. What kind of margins do you see yourself extracting for FY24? And importantly, at the 30% level now, do you think somewhere, at least for some time, the margins have sort of peaked at 30% levels?
Even without the tax change, my belief was the current construct of margins is where we will be, with 2 caveats. That any company does not drop their ranking, because if one drops one's ranking, you can get much higher levels of margins, right? That's not a difficult ask. In the case of HDFC Life, we have retained our position without dropping our rankings, and we are number 2 in the private space and number 3 overall. So assuming you hold on to your ranking, you hold and you grow faster than the market, your margins will hover in the range of say 28 to 30%, something around that. Second point I have here is that assuming that the current dynamics of commercials, what are the dynamics with one's key distributors, all of those things, because that's something that's an evolving. But as of now, I think it would hover, to your question, in the zone of between 28 to 30%. Again, we are compared, and this is a point that I do make to a lot of people tracking our sector. Please look at it in its full level of detail. When we compare India versus some of the other emerging markets, to say some other market has a 30-50% margin, that's not difficult. Indian products, thanks to our regulator, are very, very customer friendly. Take the example of a unit-linked product here versus in the emerging markets, some of the other Asian countries. You will find that much higher charge extraction on surrenders, on some of the other charges, while here it is one of the lowest.
Correct.
Even the fund management charge is one of the lowest. So it's not an apple to apple. It is not that we are not as a sector efficient and not giving margins. It's that it's overwhelming aspect that it is very pro-customer, especially what happened over the last decade has become very pro-customer, which is again a good place to be.
The important trigger which lies ahead immediately would be the merger between HDFC and HDFC Bank. For the subsidiary, in this case HDFC Life, what kind of immediate benefits do you see coming as far as 2 aspects are concerned? One is on the customer pool itself, and the second one is on branch expansion, because that will also sort of significantly aid your distribution. On both these aspects, what kind of synergies do you see coming immediately?
So HDFC Bank and HDFC Limited have articulated the benefits of this merger in terms of cross-sell to their customers. We have to understand that these are all affording middle class to upper middle class customers, as well as more recently the affordable segment as well, right? So the opportunity through digital and within data protection to be able to get customer consent to say, hey, would you like a frictionless deal? For example, you have this product, you have a mortgage but you don't have insurance, or you have insurance but you don't have a credit card, and so on. Many products, really the entire suite of products. A lot of groups are doing it, and we could, as HDFC Bank Group, could do it very efficiently and also make it accretive for the customer in terms of, like I said, frictionless onboarding, as well as a more attractive deal that we are able to give them because we know them very well. So I see a lot of that happening. Some numbers have also been articulated. For example, only a third of HDFC Limited's customers have an HDFC bank account and vice versa, and when you triangulate that. So some of that will start coming through as the merger gets consummated very, very shortly. Right?
Okay. One more thing that I want to understand, and this is on the credit life side. HDFC Bank looking at expanding its presence when it comes to the housing segment. On the credit life side, where does it stand out of the total portfolio right now? And with the merger and the expansion of its presence, how do you see that sort of triggering the growth on the credit life portfolio for HDFC?
So the entire credit life and the mortgage business and us wrapping some of the products on the mortgage side has been done well with HDFC Limited. Also for the business that has been sourced by HDFC Bank. So that well-oiled machinery is anyway has been around for a long time, and we expect now that as a culmination and then them cross-selling and growing on that base to even grow faster. So that's how we see that. So it's a well-run and well-established and integrated business in terms of how credit life works on the mortgage loans.
In terms of numbers, what kind of growth do you see on the credit life business for yourself with all these factors put in place?
So last year we grew just short of 50% overall on my credit life book. So this, this opportunity is huge, and whatever it is that HDFC Bank takes as a target going forward, we should grow in tandem with that, if not slightly higher than that, because there are many product innovations that we bring out, as well as maybe attachments, riders, those sorts of things that really it's just the tip of the iceberg.
But you see a significant addition to the current growth that you have on the credit life business with this?
No, I want to clarify that we will grow in tandem with what HDFC Bank is growing, because today we have credit life arrangements with both HDFC Limited and HDFC Bank. As that comes together, it's not going to be incremental, but will be incremental as they make it incremental. Okay. So on the back of that, on the back of their growth, we will grow, and a little bit over and above, like I said, because of product innovation.
Okay, understood. Another, of course, trigger for you has been Exide Life Insurance. You are almost towards the end of that entire process, very close to seeing tangible material returns out of that particular merger. What I want to understand from you is that what could be the immediate gains that would be reflected as far as your financials are concerned from Exide Life, and how soon do you see those tangible gains start appearing?
It's already happened in many ways. Let me talk about the top line first in terms of the whole reason why we have bought this, the erstwhile Exide Life. So in terms of having an entire vertical, which is our agency business channel, that has been consummated within overall HDFC Life. We were small, and the erstwhile Exide Life was a lot bigger. Correct. So they are now running this entire channel, and our tier 2 and 3 strategy this year, along with the customer acquisition in terms of more and more covering more and more customers. So that is one stated objective, and the second is making inroads into tier 2 and 3. I'll give you one data point. Tier 2 and 3 used to be about 60% in terms number of policies for HDFC Life. Today it is about 75% because of this. So we already are very comfortable in bringing products to a different market, in understanding underwriting process, at the same time reducing friction in those markets, as well as understanding other nuances such as you're selling through local languages, through having simple apps in local languages, evangelizing insurance, or marketing in local, all of that, so that the focus is very different in terms of growth. So that has already happened, and happy to say that we have managed to retain almost all our key partners that were there, that were attached to Exide Life. On the distribution side, yeah. And now we have both their suite of products and our suite of products, and of course there's an overlay of HDFC brand on top of it. So the day 2 technology in terms of for all the sales folks, feet on street, that's been done and dusted. Now they are able to log into the surviving IT systems, as well as our products, sell our products, the trainings are done. So really accretion on the top line. Second is on embedded value. Very well run company, no skeletons in the closet, touch wood. Up to now, whatever we thought we were buying is what will unwind, and so that are also great level of comfort that we've got. And third is cost synergies, and that as well, both in terms of people and branches. These are the large ones.
Correct.
And we have been very focused as well as fair in this to say, may the best person, the right fit for the job be there, and so on. So that also is now done and dusted, and it is one company. And Exide Life folks do occupy now senior positions within HDFC Life, the merged entity, and so on. So it is now done and dusted, and it's business as usual.
So done and dusted also means that as far as solvency and margins both are concerned, the reflection is very well factored in to what we see on HDFC Life right now, and no negative surprises there as well.
Absolutely, and hopefully we pleasantly surprise people who are tracking us, because we delivered margin neutrality at least 3 quarters before what we had hoped, because we had shared that Exide Life, because they lacked scale, their margins were low single digits versus us being close to 30, between 26 to 30. And we delivered last year margin neutrality ahead itself. So, which just means that HDFC Life's margins would have been higher to make up for the shortfall. Correct. Right? So, absolutely. So, that is also very much on track. And solvency, we ended at 203%, including Exide Life, the erstwhile. And so, that's at a comfortable solvency.
Okay. Now, what I want to understand is on a portfolio that we don't speak about much, but a recent note also threw some very important light on it. And that is the annuity book. There are now reports which are talking about how the Indian population is also, of course, getting closer to aging, still far away, but we're getting there. And annuity as a book will become very important. In the US, the Europe, we see though that portfolio is quite big as compared to India. On the private side, you're one of the, you are the leading player when it comes to annuity. What kind of growth do you see from the annuity book? Let's assume a 3 to 5 year horizon, and 40-50% margin. So from that point of view also it's significant. What's the growth that you see from this side? So
last year we had a phenomenal, last 2-3 years we had a very good trajectory on annuity. Last year we grew about 50+%, and then on a receipt premium basis, it was about 18%, while the industry grew only by about 2%. So there also, and thereby market share increase. So annuity, increasingly people are beginning to understand the important concept of longevity risk. Earlier they used to get caught up in this whole tax aspect, and this is one more example as to why tax is increasingly becoming a lesser critical reason for buying insurance. So people are now beginning to understand that where interest rates are along with inflation, net of inflation, maybe they're going to get close to 0%, and medical inflation, however, is going up. Correct. And often people have their medical inflation tied to their employer, which means when they retire, they're out on their own and would struggle to buy, or it's very expensive, and that would eat into their savings quite meaningfully. Plus disintegration of the joint family system, you have to fend for yourselves, you want to go and see the world after you retire. In all probability, one is going to survive 30-35 years after retirement, right? Against this kind of an environment, right? So no longer is it difficult to buy annuity. Plus some of the structure of products wherein a pension plan or with the government, you have to, it culminates into an annuity, right? So a combination of the structure, how socio-economic change, demographic changes are happening, like you mentioned, and products, and we now have a lot of innovation in the space of annuities, means that I would expect this to grow in comfortable double-digit numbers that are faster than company level growth. And B, I want to talk a little bit more about it. While you mentioned annuities, it's really the overall retirement opportunity. Annuities is one aspect of it, but also NPS, which is our subsidiary. Now that today or last year had a market share of about 40-45%, and recently reached the milestone of 50,000 crores of AUM. So all of that is going to culminate into annuities. So one of the key reasons of us back in time setting up this subsidiary was that the annuitization will come to a life insurance company, and one does require a fair bit of capital to be able to write annuity book,
products.
right? But at the same time, while everything is rosy, I would caution that there is an inherent um, temptation to give very aggressive rates, much better than what you're earning today.
Correct.
Other economies have done this and have paid the price heavily for it. So while everyone wants to show this growth in annuities, I think a fair bit of restraint in annuity pricing, a fair bit of governance on annuity pricing, that one has to keep repricing it based on what you're earning against it. I think that becomes very, very important.
Very important.
Yeah. And that's why companies that disclose sensitivities to interest rate movements, that needs to be watched very closely. And those companies that don't, hopefully we will see a time in the not too far off future that they also start disclosing sensitivity to key operating assumptions, which is in terms of interest rates, persistency, expenses.
Makes sense. One very important and interesting development was, of course, the budget announcement on taxing policies which move beyond 5 lakh annual premium. Takes a large share out of HDFC Life as well, about 10 to 12%. What I want to understand from you, back then you told us that this particular change will be manageable and you've started strategizing towards it. I have a two-part question. One thing is that would the base effect of having a very strong month in terms of March sort of weigh down on what you do in this financial year, or at least for the first few months? And second, what will be the strategy to sort of still keep getting customers as far as the long-term savings policies are concerned, despite the taxation headwind?
Look, when the changes happened, first of all, there was a lot said that HDFC Life has a 10 to 12% impact. My limited point is, look at the months that we have started off this year. Despite that impact, we have grown faster than the private sector, as well as a lot of other companies that relatively had a so-called lesser impact. So I think all of these are just headline items. We have a very interesting slide in our investor presentation, slide 5, and that shows that through a lot of volatility over the last decade, how HDFC Life has reimagined its business models and come out stronger, noticeably stronger, and consistently grown faster than the sector. And so we are not afraid of disruption. And one of the reasons for that is we have a balance in terms of product mix, in terms of distribution, as well as ability to innovate. So that has kept us in good stead, and that's why, while the headline was HDFC Life would have got more impacted when the changes came out, it's the same HDFC Life has delivered a lot better in the months of April and May.
Correct.
Right? And hopefully, like I said, June continues with that traction. So it goes back to basic and cutting out all the noise. Let's just triangulate. One is that the Nielsen report has shown that tax is one of the lowest reasons, so number 9th or 10th. Out of 10 reasons, it used to be amongst the top 3 reasons why people in India used to buy life insurance. That is now number 9th or 10th reason. Second is that when you look at unit linked, the changes in taxation of capping it to 2.5 lakhs, paradoxically, and we were not tracking this until the 1st of February change happened, to be honest with you. That is actually the share of policies above 2.5 lakhs has actually gone up rather than gone down, and thereby validating that tax is not the reason why people buy. Yes, tax is a reason for people who are selling it. It's easier perhaps to get customers' time, attention, and so on, but that's not the reason why a lot of our customers buy, right? And that's a validation. Third point, nothing has changed in terms of protection gap, nothing has changed in terms of just how insurance penetration has actually gone down when you compare it over the last decade. Nothing changes in terms of the socio-economic changes that people want to fend for themselves, right? The whole Sarutha KGO, as against depending on others. So that is, today nobody, or very few of our prospective customers say, why do I need insurance? Thanks to the pandemic as well.
Correct.
So a lot of these inflection points have happened. And when you look at before 4 years ago, the number of policies for every life insurer, including us, was nicely increasing, right? And then we went up the ticket size journey. to some extent, not hugely, but here and there. So I think it's going back to basics of how do you focus on connecting with more and more customers, how do you build this back brick by brick. And when I looked at my data for April and May, and when I looked at below 5 lakh, my growth is about, in a lot of cohorts, above 40%.
40%.
Right? So people do want to buy. So it's a myth that they don't want to. Yes, some upfronting has happened to March, but that will settle down. And the whole machinery of your sales teams have to change to going back to a pitch, that is to say, going back to basics. And having those conversations with people. And like I said, I'm very, very pleased that protection is back. Right? So sometimes what happens is if I get 15 minutes with a customer, I will try and do a need-based selling, but protection is a little bit more difficult and involved in conversation as well as back-end on conversion, right? In terms of underwriting and so on. So all of that is beginning to happen. Annuity is selling very well. Retirement is selling very well.
So as you said, nothing that was anticipated would happen for a company who has a higher exposure actually turned out, as we see in the month of April and May. And one reason that you pointed out for that was a balanced product mix, where another product segment sort of made up if there was a shortfall in one product segment, and that's how you sailed through and showed good numbers. What I particularly want to understand is that as far as long-term savings is concerned, more than 5 lakhs, and you have a very successful flagship product there, Jeevan Sanchay. What I want to understand is that what kind of change did you see between March and let's say April and May when it comes to long-term savings or this particular product segment in terms of the traction?
So I want to say that overall non-par long-term savings for April and May has grown. Okay, so it's a myth that it has not grown. But above 5 lakhs has shown a degrowth, which was expected. Now that degrowth could be because of two reasons. One is because people in that bucket already advanced their purchases in the month of March. I myself did, for example, in the sense that, you kind of pull out some of your other savings and you buy the policy, right? So that is but natural. Second reason is that people want to wait and watch as how, where do they distribute and so on. As it is, April and May tends to be a little bit slower before the momentum picks up. So it's really too early to say. What is important is that the below two things. One is the below 5 lakhs some of those cohorts has grown between 40 to 45% in the months of April and May. Similarly, non-par as a cohort has also shown growth. Right? So I think we are on a good wicket. I think this will continue.
It's fair to say, looking at the numbers, so far so good. But with that statement, what also comes is that right now you have about 7.5 lakh of a premium contribution which does not get taxed. 5 lakh on the savings side and about 2.5 lakhs on the ULIP side. Do you see a genuine risk of this amount also coming under taxation at some point from the government side? And if that happens, then does it start increasing the risk for insurance companies' portfolio?
So, couple of points here again. One is that worldwide, people need a nudge to buy insurance because people intrinsically don't want to talk about risks. And so it's a little bit of sweetener. So it's not an India-specific thing about giving some level of taxation, right? So I would hope that we continue because this is human behavior and like I said, not India-specific.
We continue with the 7.5
That we continue with the 7.5 lakhs. In fact, my ask would be why not collapse the 7.5 lakhs? Why should we micromanage the prospective customer that, you can only buy in this pot versus that pot? Why not he or she buy everything ULIP if they want to, or everything as participating, or everything non-par, or some hybrid between these, right?
Within the limit of 7.5.
Within the limit of 7.5. That would be my appeal to the government. On the second point is that over a period of time, I am also of the belief that people will start realizing the need for insurance, and I'll explain. I've seen in other markets, the single biggest driver is per capita GDP. So as that starts going up, and India has shown a phenomenal track record in terms of progress, then the average person will say, I'm now worried about losing something, I'm the breadwinner, and thinking along those lines. Some of the emerging market economies are maybe anything between 2x to maybe 5x India. Right? So this is a matter of time. So until we get there, some level of these sweeteners will help. Once we get to those levels of affluence, then perhaps it could be reduced down the line. But as of now, I think it would be doing disservice. Also looking at the overall while HDFC Life has grown, overall industry has not, and so I think it would be doing disservice to have a knee-jerk reaction on that.
Fair point. I want to understand something about your guaranteed return portfolio, and one question there. What is the current gross surrender value that you have out of the total premium, let's say between the 7th and the 12th year that you get?
More than specifics of what do we have, it's whatever is as per regulations, and you have to comply with it. It's a slab base, and you have to comply with the regulations. And I am aware of where you're coming from. I want to make a few points here. Number one is that no discussion has been had with our regulator on this. Number two is that what is important is that the pricing and the actuarial assumptions are in cohesion with what you're actually experiencing. So if one is having say a persistency, a 13-month persistency in a guaranteed product of 90%, but one is pricing in and showing new business margins as if your persistency is going to be 85% because you're expecting 5% to surrender, then there is a disconnect between the two. So one of the metrics to watch out for, and unfortunately not a lot of companies other than the listed companies disclose this, which is the embedded value walk from a period to period, and I hope that we progress to that. That will show that against your operating assumptions, how are we trending, and that you can see in operating variance. So that becomes important. And second is, what is your sensitivity to interest rates? That will also show in terms of if there's a lot of volatility and lot of large movements in sensitivity to your new business margins and value of new business, then clearly one is having very aggressive assumptions. I think that's what it goes back to. But at the same time, in defense of the industry, I want to make this appeal, and that is as follows. It is always dangerous to compare one aspect of one industry and another aspect of another industry, and third reason being that this product construct gives what no other product construct, and I would like to double underline the no other product, because you're giving a guarantee for the next 25 plus years, right? Which means that insurance companies have to have much larger levels of capital, will have to do ALM matching, hedging, forward rate agreements to be able to give that guarantee to that individual and give that interest rate that an individual knows today, which nobody will know what it is by the time he starts getting that money, right? And so then to say that, okay, me as the customer, I'll have the guarantee, but I hold the right to exit after year 2 and no surrender charges, I think it's somewhat lopsided.
Okay. So even if there are discussions on reducing the surrender charges, I think it's about 30% minus the first year premium that the customer receives. If to what the conversations are at the regulatory front to increase that 30% in terms of surrender value, you think that it should not be done, and the current structure that we have with respect to 30% should be maintained because of the aspects that you mentioned?
Yes, and before we get to the answer as to should we or should we not, it is important to see versus actuarial assumptions, what are companies trending with. That is baby step number 1, and we would wholeheartedly welcome disclosure on that front in terms of sensitivities. Then we can see whether there's a problem that needs to be fixed or it doesn't need to be fixed.
A few quick questions. One is, if there is any impact of the taxation announcement, then the companies will have to grow their protection portfolios significantly and focus on that side. For you, where does protection stand as a part of the product mix? What kind of growth do you see for the next 2 to 3 years in the protection portfolio? And with that growth, what kind of share would it take if we see 3 years in future as a part of your product mix?
So we see protection as one cohort comprising credit life, which is nothing but pure protection on a group avatar, and retail protection. I'll talk about credit life first. Credit life has been growing in the range of between 40% to 80%. We expect growth to be at least 30+%, and continuing to grow many lines of business, and on piggybacking on various NBFCs, banks, MFIs, small finance banks, and so on, and of course our parent. So that will continue very well, and that is, like I said, pure protection. Also attachment of riders and so on. The other part is on retail protection, which has gone through ups and downs. We grew very well during pandemic, and then thereafter Delta wave. It was a perfect storm in terms of how, reinsurers, just in terms of the mortality experience and all of that. And then we had FY23, which was a great year too, as a change in that downward spiral, because we started showing quarter-on-quarter growth, and also year-on-year growth for standalone Q4. So 30+% in terms of growth, covering more and more lives, and not going kind of high ticket covers, but all spread across our customer base very well. I'm fairly hopeful. If you look at the 2 months data that is in the public domain, you will see that for HDFC Life, the retail sum assured growth has been upwards of 50%. So that growth in terms of retail protection is back, and even credit life is back. So I would expect this to see. Having said that, I'm of the school of thought that it is not difficult to grow protection, and what is infinitely more difficult is to triangulate profitability as well as your risk management. And a lot of aggression that one can see in a developing country like ours will come back to bite, because you're not covering just 10 years of life, you're covering say 30 years of life. And if one gets it wrong, then it might actually start unraveling a few years from now. We will not come to know. So it will look like headline item that protection is growing. One has to be very careful on it. But nothing has changed in terms of growth prospects. I think phenomenal growth prospects. Also, when you triangulate, say, Google searches, look at that, continues to be robust. And within whoever is searching, HDFC Life continues to trend right up. So I think it's a brick by brick business. I think the pricing has to be right. The underwriting has to be both robust as well as trying to make it frictionless. You have to balance the two, and hence the profitability has to be at least in line with company level profitability. And 2 to 3 years in the future, the share out of your product? The share, sorry. Yeah. So today it's hovering for us about 4-5%. This is only on the retail side. That should continue to go. But more than share, I'm not a great believer in share, because it's also relative to what something else is growing. So for example, this year, if I say my savings are going to grow at mid-teens, my protection is artificially going to look up. What I am tracking is that my protection, retail protection should grow faster than company level protection. I think that should continue to happen. One question as far as one recent development is concerned. Aberdeen, erstwhile Standard Life, sold about 1.6% stake in HDFC Life. Just want a confirmation, was that stake bought by HDFC, and are we through that 50% threshold? No, that stake was not bought, because there is some approvals, regulatory approvals that are still pending to be able to buy our stake. Hopefully that should come very shortly, and then they will be able to buy. So HDFC wasn't the buyer in that block deal? No. Okay. One last question. We've seen 2 tragedies in very quick succession. One was the Orissa train incident, and now we are looking at Biparjoy storm. In fact, the storm happens to be in the state where you are the lead insurance company. What was the claims experience so far that you've received from the train incident, from the train tragedy? And here, being the lead insurer, what sort of expectation do you have, if at all, coming from the claims side? So this, goes back to this woefully underinsured population of ours. And that's unfortunately every event, whether it is in the Mumbai blast or whether it is in many floods that we have had and so on, or natural calamities, or Bhuj in terms of earthquake, and now this in Orissa. Unfortunately, nowhere near the numbers that we should have got as claims. And we've had a lot of engagement at local level as well as in media for people to give really very little in terms of hoops to go through before they get their claim, but and that's what I understand from a lot of my peers as well. So level of insurance is fairly low. Similarly here, I mean, I hope there's a little bit of hit and miss, and the landfall happens a little bit separately away from the main populous areas. But I think let's see how that pans out. But up to now, in terms of natural calamities, we've had very few claims.
Okay.
And that's exactly what our regulators rightly saying, that let us go to the grassroots and through the vehicles of Bima Vahak, which would largely be women who would be able to sell some of the simple composite policies, because both life, general health, and they're called Bima Vistar. So some of that hopefully will start getting traction.
Shape.
There's also PMJJBY, but again, how many nominees know about it, how many claim?
Correct.
These are all structural challenges that all of us should be working on.
Let's conclude this interaction by congratulating you. Godigit, of course, received its approval from the regulator to start insurance company. The bank has about 10%, 9.99% stake in it. Very quick comment. Do you look at leveraging Godigit's digital presence or other modes of distribution for distributing HDFC Life products as well? And what's the rationale behind this stake purchase? Could this go up further in that context?
So this is what I understand is an investment like the bank invests in many entities. Anything over and above 9.9% would be a constraint for the bank. And I understand that other banks also have invested. So it's a purely financial investment.
Would they help in distribution?
Who would help?
Godigit's digital network, would they also distribute HDFC Life products in some way?
I think while this is a question for the bank, what I understand that they're very happy right now with the open architecture that they have. And in fact, a lot of other banks haven't opened up at all. I think that's a question for them.
Absolutely. Thank you so much for speaking to CNBC TV18. Always a pleasure.
Thank you. Thanks.